I'll start with a sign of the times here. My favorite this week is the Mesa Police Department told people they should stop having house parties while they were in quarantine. My second favorite this week is, did you all see that in Kentucky they're telling people to wear pants when they go get their mail from the mailbox? That kind of goes along with Walmart saying they're selling shirts 3-to-1 to pants. Putting that aside, a real sign of the times right now and how things are going is basically two builders out there, Marquet Homes and Taylor Morrison. Last week, at the end of the week, Marquet Homes, as part of the housing report, reported that they had the decline in sales at the highest level or the largest decline they've ever seen, worse than what they had in 2005 and 6, which was the downturn of the market. What's interesting about that is in the same report, Taylor Morrison, which is the same size builder as Marquet, especially here in Arizona, they're building just as many houses or subdivisions. In many cases, they're building subdivisions right next to each other. Taylor Morrison notes it hit an all-time high in home sales. So you got one home builder saying they're hitting an all-time low. You got one home builder saying they're hitting an all-time high. How can we have both be true? And kind of part of the problem is it's not that there's not demand for housing or Taylor Morrison wouldn't be able to hit an all-time high. It's not that there's a lack of demand for housing or all builders would be going down. In this case, since in many areas, these builders are building right next to each other, it's not the old real estate location issue because they're next to each other. And I'll just add in, their prices are very similar. Taylor Morrison is probably a little more expensive than Marquet. Marquet tends to have a little more of the starter homes. Taylor Morrison does not. So in theory, Taylor Morrison should have been suffering more trouble. So why is there a difference between the two? And it's all in their marketing. Marquet Homes, as soon as the virus started, they shut down their visitor centers and they claimed they were leaving their models open. But when they shut down the office, people didn't come and go through their models. And since Marquet was scared, people were wondering what was going on that scared them. So they were scared to go look. Taylor Morrison, on the other hand, kept their models open through the third week in March. And that's the difference in sales. People could still go do contracts. It's nice to say if you're a builder that people want to do contracts, they can do contracts by appointment only. But let's face it, when somebody wants to buy a house, I don't want to say it's an impulse item, but in some ways it is an impulse item. They're not going to wait. When they decide they want to buy a home and they're sitting in your home, the traditional logic, whether you're doing timeshare sales or new home sales, says you got to get them under contract then when they're ready and willing. If you're going to make them go home and think about it, then they're going to think about looking at other houses. And that's really what happened to Marquet. Marquet has suffered significantly because of a decision to close the economy. The reason I bring that up as a sign of the times, isn't that really what's happening in the economy across the board? Aren't we really all suffering because of decisions to close the economy? Started with bars and restaurants and went on. There's been some positives out of this before we get into the housing market and what we should be looking at. I mean, one of the biggest positives I've seen lately is lumber has gone down in price. Lumber's approaching 1982 prices, which for those of us that were alive back then and not in the Air Force, prices were cheap for lumber back then. And then the build out started happening worldwide and lumber prices went wild. Even more interesting, lumber futures. Lumber futures right now are at their lowest level since they started tracking them in the 70s. Why would lumber be falling? Because demand fell. Why is the demand for lumber so important to us? Who's the number one user of lumber? Builders. Builders' demand fall down. That means builders aren't building houses. Builders aren't building houses. the economy doesn't have a lot of slack supply when the economy starts to pull out or recover to meet buyer demand. And everything in this is supply and demand. It always is in housing or any other durable good. Housing's a durable good, not often looked at that way, but regardless it is. We had a supply problem coming into this. The builders were coming online to fix some of the supply problem, and now we're seeing the builders are slacking off for more than one reason, but they're slacking off, which is driving the price of lumber down, which means builders aren't demanding as much lumber, which means they're not helping fix the problem. So even if demand were to freeze where it was when the market was, let's say, forcibly shut or government shut or whatever, I'll leave that alone. If we say demand froze at that point, we were counting on builders to make up the slack. The builders aren't doing it. As a matter of fact, it's no great secret. New home starts are down. New building permits are down. So the homes that would be ready tomorrow aren't being built. And the homes that would be ready 90 days from now or 180 days from now, which were the permits, aren't being built. So basically what we're looking at is we're looking at a similar scenario that we had back in 2013-14 again, where we need more homes, but the builders aren't building them. So the resale market gets overwhelmed. That's the good news. The bad news is the resale market gets overwhelmed. That makes it harder to find deals as investors. So everything has a plus and a minus. Everything is accountable. The biggest battle is figuring out what's going on in the economy and in the market. Another thing that I found that's kind of a sign of the times lately. Let's take a look at the market movement for a little bit. You know, in today's market, we have really two different things going on. We have the housing economy and we have the COVID-19. In the middle there, we had, shall we say, the stock pandemic, where the stock market got afraid of its shadow, and every time its shadow would show up, it jumped, and the sun's been out for a solid month and they haven't stopped jumping yet. Good news is they're jumping up more than down now, but we had lots of fear. I mean, if we were having this conversation back in March when the stock market started tanking on the 16th, exactly 1 month ago, we'd be talking about how the stock market is afraid that COVID-19, or sometimes I refer to it as the bat virus, I get that from MSNBC, or the Chinese virus or the Wuhan virus, I don't care what we call it, I'm not worried about being politically correct. But COVID-19, this virus, the fear that the stock market had was it was going to impact the ability to supply goods in the supply chain. Now, America works in the just-in-time inventory everywhere. When a builder is building a house, he's relying on the faucets and the fixtures for inside the house to arrive when he needs them, not earlier, because he doesn't want to store them. So the people that sell that stuff to him ship it in storage containers from China. When China starts shutting down its economy, the fear is that equipment's not going to arrive anymore to build the houses. It's not only housing, it's everything. So the stock market starts panicking. And then the numbers come out showing COVID is going to be really serious. At that point, it was 1 in 3 people will catch it. And out of the 3 people that catch it, somewhere around 1 in 10 will die, which is a huge death rate. We now know that that was all utter bunk, and we could have guessed it then. I mean, the area in Wuhan has 45 million people, and China didn't have that high of a penetration for the virus, although we now know they possibly lied. But as we look at it, the fear of the supply chain is making the market react negatively because we may not be able to service and we may have a disease impacting us. If we keep looking at it and we remember a week later, suddenly they started talking in the news media about the oil problem with Russia and Saudi Arabia, basically, or the OPEC nations, really Saudi Arabia. The funny part about all that was the OPEC meeting happened in January, 3 months before, and Russia walked out of the OPEC meeting because they didn't want to agree to the OPEC terms. So the oil instability was already built in to the bond market. And yet when the stock market tanked, so did the bond market. Usually when the stock market tanks, people move their money to bonds. When the bond market tanks, people move their money to stocks. Unfortunately or fortunately, depending on which side you want to be on, you notice I didn't say real estate in any of that. So why would the Russian price war with OPEC cause stocks to tank more? Because the stock market was afraid of its shadow. You've got 1,000 people standing in a pit on Wall Street, and they're just feeding off each other's panic. It's kind of like going into a movie theater and yelling fire. There may not be a fire, but one person says they saw a fire and everybody starts panicking and running over each other trying to get out. That's what happened with the stock market. That's why after they forced the shutdown on the Monday following March 16th, the stock market actually went up for a while and then went down. You notice the stock market has been climbing for the last couple of weeks, slowly but surely. It's still bouncing around, but it's ending the days up. I mean, the Dow Jones ended last week up 12.7. The S&P 500 was up 12.1, and the NASDAQ was up 10.6. As a matter of fact, the Dow ended yesterday up another 2,100 points. So they're bouncing around, but they're still ending up. One of the best things that the government did, or that the SEC did, which is still the government, is they shut the trading floor because they were afraid of people passing coronavirus. When they shut the trading floor, just like all of us, people were stuck in their homes having to make decisions based on what they could see and think about. On the trading floor, they don't think. There's mob mentality. When we got rid of the mob mentality, the stock market stabilized a little bit. For the last several weeks, I've been telling you when the stock market quits reacting to bad news, the economy's in recovery. The stock market quit reacting to bad news 2 weeks ago. We've seen the stock market start going up, even though the number of corona deaths is going down or going up also. We saw the stock market quit worrying about it long before we hit 100,000. And they don't seem to be worried about it that much anymore. And that's the good news. The bad news is how it impacts real estate, because that's all we really care about, right? Stocks are nice, the economy's nice, but how does it impact real estate? And it really has two impacts in real estate that we care about. The first major impact to real estate is how it impacts the jobs of people buying houses, or the ability to afford housing. And the second impact in real estate is how it impacts the tools that are using to buy that housing. So what's the most common tool we use? Lending. People borrow money to buy a house. Well, when they borrow money to buy a house, that's dictated on a treasury bond what those interest rates are going to be, as much or more so than anything the Fed does. Going on a side note here, I just got to say, if you all remember, one of the reasons stocks took a hit was because of the Fed. If the Fed was a corporation and the corporation stock took a hit the way the Fed caused the market to take a hit, the federal government would be going after the corporate officers for breach of their fiduciary duty. In other words, they weren't acting in the best interest of the corporation. The Fed is a corporation. Somebody should go after the Fed for utter stupidity. But considering the Fed has been showing a lot of stupidity lately, I'm not sure where you would stop that. But if you remember, the Fed was expected to have a meeting in March. On a Sunday following March 16th, the very next Sunday, the Fed came out and said they were lowering interest rates a quarter of a point. And the stock market tanked that Monday because of that announcement. Why did it tank? Because the stock market was already in fear. Now the Fed says it's lowering the interest rates a quarter, and the stock market says, whoa, what are we missing? Something's wrong, and they start selling off. And in today's world, Selling off doesn't happen by raising your hand like it did in the Dan Aykroyd, Eddie Murphy movie years ago. Selling off happens on a computerized program. So when somebody says, sell what we have on the program, it immediately puts out a complete sale on everything, drives the market down. Unfortunately, the Fed did the same thing again 3 days later, and they lowered the interest rates to 0. And they announced they were going to spend $2.3 trillion to buy back treasury bonds to stabilize the market. Lost in all this is the move the first week of April, the 1st of April, where they announced they were spending an additional $2.3 trillion to buy more treasury bonds because the first stabilization didn't happen. I want you to remember that, because we're going to talk a little more about the Fed later on and the concern they may not have any more tools in their quiver. But remember, the Fed lowered the interest rates to 0. The thing to remember as investors is that doesn't mean the interest rate to borrow money for housing went to 0. It means the interest rate at which the banks borrow money went to 0. The interest rates for that you use for your loans, be they revolving or non-revolving, be they major credit like a house or supplemental credit like a car, those loans are all based on market value. Market value has absolutely 100% nothing to do with the Fed. The only way the Fed can help market value is through a process called quantitative easing. And what that does is that's the $2.3 trillion they were using to buy back federal bonds. Now understand, in our real estate world, there's 3 bonds that we're concerned with. And I'm going to tell you all 3, and I'm going to tell you to ignore 2 of them because we don't pay much attention to them anymore. There's the 5-year Treasury note, there's the 10-year Treasury, and the 15-year Treasury. The 5-year Treasury has been stable since the 23rd of March at about 3.4%. That's good. The 15-year has fallen 5 basis points in the last week to 2.77%. That's not too bad. But we don't care about those anymore, because what we use generally with interest rates today is we use the 10-year index or the 10-year yield, which is still the 10-year Treasury bond. The 10-year Treasury has been sitting at 1% and bouncing around plus or minus. The 10-year Treasury has been sitting there bouncing around plus or minus 1 point. That's not enough to change interest rates, really, but it's also stabilized from when it was bouncing around plus or minus 5 points. So if we were to go back to the 3rd week in March and the 4th week in March, there were interest rates on 30-year fixed loans approaching 4.7%. That's a lot, considering interest rates were 3.6 before that, going to 4.7. What do you think's happening to all the people that were trying to refinance? They stopped. They quit refinancing. Now, the news media reported it that the demand for mortgages had gone way down. As a matter of fact, I can remember on the 23rd of March, the media reported that financing was in trouble because the refinance mortgage rates, which had gone up 79% the week before, had dropped 115%. Now, first off, you can't drop 115%, but that's beside the point. What they were missing is the fact that interest rates were bouncing all over the place. If you were showing an interest rate graph on March 23rd through almost March 28th, maybe March 30th, it looked like a 3-year-old kid had drawn it. It was just a bunch of squiggly lines drawn all over the place, because interest rates were bouncing based on the 10-year Treasury. When the Fed went out and used the $2.3 trillion to buy the Treasury yield, that stabilized the Treasury yield, it stabilized the interest rates. But it didn't stabilize it enough because it was still bouncing. That's why the Fed decided to spend another $2.3 trillion. if we had more time, I'd go into the fact that they're actually only spending about 10 cents on the dollar on each bond, but that's beside the point, sometimes less than that. But by buying the treasuries, they've stabilized it now so that the Fed, the 10-year treasury index is only bouncing about 1 point plus and minus. And that's not bad. Normally, when the treasury yield goes down, interest rates go up. When the treasury yield goes up, interest rates go down. Interest rates are sitting at 3.3. The treasury yield's not in bad shape. When it goes down 1 point, we would expect our interest rates to drop about 1/4 of a point, between 1/8 and 1/4. But we're not seeing that right now. Well, we're an open market economy, and I don't know how to do this nicely, so I'm just going to say it. You can do with it what you want. We're an open market economy, but just because we're an open market economy, it does not mean that everything relies on the market. Just like you as a business person, when you look at buying a house or you look at doing a real estate investment, you have a number or a nut that you have to make for the investment to make sense, because you have to make money, right? A bank is a business. Why would they be any different? A bank has to make money. And here's the problem for banks today, and it's been a problem for the last 5 years. When a lender does a loan for you, and they do a loan at, say, 4.7%, because you did a loan in the last 20 days, and actually the average mortgage rate in the United States right now for the last 5 years is 4.25%. The old rule of thumb for refinancing was when interest rates drop 1 point, or when your appreciation goes up more than 20%, you should refinance. The old more than 20% was to get rid of PMI. The interest rate down 1 point was worth somewhere around $125 in payment, in theory. Sometimes a little more, sometimes a little less, but in theory. If you're a bank and you're making loans in today's market, your rate on that loan is figured over a number of years. If we were to go back to the 90s, the rate on the loan was figured over 15 years. So for 15 years, you paid mostly interest, and that's how the bank got their money back. The other 15 years, you paid mostly principal, and that interest you paid for the last 15 out of the 30-year loan was profit for the bank. But the bank had already made their number to make them whole. If we go back to the 70s, that was actually 20 to 21 years. If we go back to the 60s, it was 23 to 25 years. So the number's been getting shorter. And most of the 2000s, when we started 2000, banks were figuring 5 to 10 years. Banks have gotten better. They have done a better job, shall we say, masquerading fees or streamlining fees. And now generally a bank looks at 3 to 6 years to get their money back. Well, if we look at the interest rates in the last 3 to 6 years, and we look at numbers like March 16th, there was a 79% increase in refinances. April 3rd, the increase in refinances was 52%. Banks aren't getting 3 to 6 years. When the loans get refinanced, the banks aren't actually making their money. They're technically, quote unquote, losing money on the loan. So the banks have a number that has to work for them. And without going into anything, there was a rumor that came out, and the source of the rumor was CNN originally, and the New York Times, that said some of the major finance lenders for housing got together and discussed how low they would let the interest rates go. It's no surprise that that number came back at 3%, because that's the basis number for the banks. If the interest rate gets below 3%, there's no way the bank can make their money. It's kind of like you trying to make money on your savings account right now. It's a joke. Bank has the same problem, and the bank has rules that they have to follow. So will the interest rate go below 3%? If it does, it won't stay there long, but not likely. We're sitting right now today at 3.33, and there's a possibility by the end of this month we can see 3.1. Personally, I think that's the lowest we'll get. After that, the interest rates will start climbing again. 10-year yield bonds can't stay down forever. Stock market is starting to stabilize. And I think as we see the economy open up a little more, Treasury bonds become more stable. By the way, the number one purchaser of Treasury bonds besides the Fed isn't in this country. It's England and China. So lending rates are good right now. Long way, long message short. Write down, lending rates are good right now. 3.3%. I mean, take a look at what you're paying in interest on 3.3%. You all have a calculator in your phone, use it. Basically, your interest payment is a rounding error on your taxes and insurance. So you're back to, you can get a loan on an average house and pay a sub-average mortgage payment. So by the way, primary mortgages or principal mortgages or first-time mortgages dropped, the week ending 4/3 dropped 12.3%, and refinances dropped 19%. In case you want to keep track of it. One of the problems that we said, there were two things we were concerned about. The sources, and we're concentrating on mortgage rates right now, and sellers, and in jobs, income. Have incomes taken a beating? Sure. Have layoffs gone rampant? Sure. We saw 3 weeks ago, 6.6 million people applied for unemployment. Last week, 6.2 million people applied for unemployment. And we now know this week the number is 5.5 million applied for unemployment. Does that mean they're all unemployed? No. If you think that means everybody's unemployed, you're not looking at the numbers right. A couple things to remember on unemployment. Number one, the stimulus package said anybody could apply for unemployment that was impacted by the coronavirus, even if they were still employed, but their income had taken a hit. When you go on to apply for unemployment, you go through a questionnaire, and the questionnaire has two flow charts. You don't work, or you're still working, but not full. You're not getting full pay. And there's two different payouts for it. As far as the $600 federal payment, it doesn't matter, it goes to both. Only the state payment differentiates between the two. So we've got people that are underemployed. We've got people that could never get unemployment before, the gig workers, the independent contractors, and it waived, the stimulus package waived the requirement to look for jobs. And it waived the long-term unemployment waivers. So basically, when we started this, we had 6.6 million jobs available, and we had 7.2 million people that were long-term unemployed. In other words, they weren't looking for a job because there were jobs available and they weren't going for them. Whether they didn't want to work those jobs, whether they didn't want to work, it doesn't really matter. We had jobs, we had people that were unemployed. That number of 7 million has been hanging around there for 2 years. All those people now apply for unemployment too because they're now eligible. They weren't eligible under the old system because they had timed out. They were called terminal unemployed. Now they're eligible. So the numbers that you're seeing on the media, that 17 million number, it's actually really only 10 because 7 million of them were already unemployed before this started. But be that as it may, unemployment has risen. There's no doubt about it. Most of the service workers that were working in restaurants and bars and other stuff are no longer employed. But here's the problem with that. Are they the people that were buying houses? In some cases, yes, on the very bottom end of the market, but in most cases, not really. They were the renters, which is causing a problem for landlords. But we're on mortgages now, so I want to leave that alone. They were the renters. So they're not paying their rent, which is causing landlords not to be able to pay their mortgages. And there's been no amount of write-up on that I can tell you any more than the talking heads are talking about. But what about the people that aren't paying their mortgages? We've seen a huge influx of people not paying mortgages, partially because they've been told they can get a year without paying their mortgage. And that's what the media said. CNN was called on the carpet for it, and they said we misunderstood what they meant. ABC was called on the carpet for it, and they said that was their understanding. That's really not what was the understanding. There were two programs out there that have been around for frickin' ever. And back March 1st, Freddie Mac and Fannie Mae came out and said, we have a forbearance program. We have a defeasance or a delayed payment program that they're now calling a temporary halt to payments, which is where the confusion comes in. And we expect COVID-19 to be applicable to those programs. March 23rd, they put out a much better write-up on it that basically said, if you have lost your job directly from COVID-19, then you're eligible to either delay your payments for a set period of months or do a forbearance program. And the forbearance program fundamentally says, I can't make my payments, here's what I think I can pay, and they add the rest onto the loan. The problem with a forbearance program is you're paying interest on interest, because if you're in the early parts of your loan, 80 or 90% of it is interest. If you can only pay 10% or 20% of your loan, you're paying that interest rate. The rest of the interest and the principal and the taxes and the insurance that's coming out of your escrow account is added to the rear of your loan, making your loan higher, and you're being charged interest on that new loan amount, which has interest in it. So forbearance programs aren't great unless it's an emergency, which leads people like Dave Ramsey on his news show all this week, all last week. Every day he opens his news show with two simple comments. If you can pay your rent, you should. If you can pay your mortgage, you should. But the media opens their newscast saying you can get 12 months of not paying mortgages. So suddenly, let me back up for a minute. Back March 18th to March 20th, we were getting phone calls from people that wanted to buy houses since the interest rate was zero and they wouldn't have to pay interest to buy their house. Not only were we as real estate professionals spending a lot of time explaining to them that's not what it meant, but that's all I heard lenders doing, explaining that's not what it means. And people still weren't getting it because the media wasn't helping. The media was pushing out their rules. Well, now we move forward to the loan forbearance program, and people are being told they don't have to make a 12-month payment, and that's what they're being told. You don't have to make a 12-month payment. So people are calling in and they want to know about the debt forgiveness program. There is no debt forgiveness program. There's a deferral or forbearance. Last week, we saw, based on what we saw last year for last week to this year for last week, for just that week, year-to-year comparison, week-to-week, we saw an 1,896% increase in people requesting mortgage forgiveness. Almost 2,000% increase in people requesting it. Most of them weren't requesting it because they couldn't make the payment, although there were some. A lot of them were requesting it just like the people that requested the DIDL loan from the Small Business Association. because they said you could get it just for asking. So why not ask? All they can do is say no. So people were requesting the loan forgiveness program, but there's not one. There's a forbearance program and a deferral program. The deferral program is really simple. It allows you not to pay your mortgage during the COVID-19 or the bat virus scare for the time that businesses are shut down. So right now, that would be, March was already paid, so that would be April and May right now, by and large. But you have to have a direct impact. And direct impact was narrowly defined by the FHA, the VA, as well as Fannie, Freddie, and Ginnie. You had to be directly laid off because of the coronavirus and prove it. Your income had to be reduced because of the coronavirus and prove it. You had to take care of somebody that was proven to be sick with the coronavirus and prove it. Or you had to be home taking care of your kids and not able to work because your kids were out of school. Obviously, the last one's the easiest one to prove because every school shut down. But it had to be a direct correlation. And we're going to come back to direct because the same thing applies to tenants. So the deferral program was easy. But the problem with the deferral program is it only gives you those months off. And then in that third month, so you don't have to make a payment in April, you don't have to make a payment in May, but in June, all 3 payments are due. If you can't pay all 3 payments in June, then we go back to the forbearance program. And the forbearance program takes the unused portion and makes a payment agreement with it. The problem with the forbearance program, if you haven't seen it, is so many people were requesting forbearance. Most banks decided they were going to give 180-day forbearance and then the whole payment was due. But reality is most people can't make the 180 days. They can't make that 6 months worth of mortgage payments. I mean, if you're used to making a $1,000 mortgage payment, now 180 days from now you owe $6,000. Even with the government $1,200 stimulus or whatever you're going to get, and the extra $600 in unemployment that could have been making your mortgage payment all along, you use for something else, so now it's not available, you're not going to make it, which leads people to believe foreclosures are going to rise. Unfortunately, that cause and correlation is a bad analysis. Foreclosures rise when people can't make their mortgage payments. There is no bank in its right mind in this economy that's going to make somebody foreclose because they couldn't make their mortgage payment. And the lack of goodwill it would create for banks would make the problem Bank of America has in public support and public trust look minor. There's not a bank out there that's not going to work on the deferral program or the forbearance program to make sure you can make your payments. In the end, you're going to end up paying more for your house than you started. So foreclosures aren't going to rise much more than they have been. Now, I've been saying this for years, and a lot of real estate investors seem to miss this point, but foreclosures are normally 3 to 3.6% of our market share. That means out of all the houses in your market at any given time, somewhere between 3 and 3.6% are somewhere in the foreclosure process. That doesn't mean they're actually going to auction, or it doesn't mean the bank's actually getting them back. It means the loan has entered a default point. Understand, 2/3 of those are repaired before they ever go to auction. Lately, since 2008, when the big foreclosures kind of ended, okay, maybe 10 when the big foreclosures kind of ended, but the banks already owned them in 10. We've been seeing the foreclosure rate run somewhere between 2.5 and 2.7. So the foreclosure rate's been running low. In some parts, like where James lives in California, we've been seeing it run somewhere around 1.7, 2.2. In parts of Chicago, we've been seeing it run around 1.5. So the foreclosure rate has been really low. And it's important to know that the foreclosure rate is historically very low. In order for the foreclosure rate to go up, I saw an article in USA Today that said it could go up to 16 to 20%. In order for it to jump that much, there would have to be a major change. The major change USA Today is counting on is the fact the economy stays shut down and people can't pay their mortgages, because we saw hourly jobs go away. Now we're seeing professional jobs go away. Some companies are announcing they're laying off doctors and nurses, which surprises me. Some companies are announcing they're laying off high-tech workers, but none of them are laying off very many. And we've got several companies out there trying to hire people back. So right now in that industry, it's a wash unless somebody wants to be unemployed fundamentally. So the USA Today article, which is quoted in almost every media, saying foreclosures are going to tick up a minimum of 5 points, but maybe as high as 16 or 20%, relies on a long-term shutdown and long-term unemployment. I don't think that's going to happen. But even if I assume they're correct, if I play lawyer, then I have to look at it and say, are the banks actually going to force those people into foreclosure? Or are the banks going to take the hit and see if they can work with them first? And if the banks work with them, some of those will still go to foreclosure, but a lot less. As a matter of fact, 2/3 of people work out the foreclosure before it happens. So it's a reasonable assumption to say 2/3 of the people going through the forbearance will work it out. So that's only 1/3 of the number. That means the foreclosure rate might hit 4%, but probably not. Because you got to remember, the basis they're using 2005 to 8, the real estate market was built on smoke and mirrors. If you could fog a mirror, you could get a loan. No money in the house, no nothing, no reason to stay. The real estate market today, since 2010, is built on real money. You put money down to buy your house, except for some of the people that qualified for special government programs, and that's very few. Most people put down, back in 2010, 11, and 12, put down anywhere between 10 and 15, maybe as high as 22%, depending on their credit. In the last several years, people have put down on average 5% to get in a home. On the low end. On the high end, they put in 10 to 12%. 12%'s average. So there's money in the loan. There's a reason people don't want to walk away from them. So to assume that the foreclosures are going to go up is a little brash. But let me go back to the thought. People aren't paying their mortgage, they're requesting a forbearance program. Basically today, it's kind of like unemployment. If you apply for unemployment, you're supposed to have proof that the coronavirus caused it. How many of you think your unemployment system in your state is really checking that? If you say you're unemployed and you say the coronavirus caused it, and they're getting, Arizona, we would normally get 2,000 or 3,000 people a week. We're getting 50 to 60,000 people a week applying. And then 1 week, 2 weeks ago, we had 130,000 people applying. All they can do is process the application and get the debit cards to the people to put the money on. They don't have time to verify anything. Might they in the future? Sure. But let's see, in Arizona for unemployment, and I'll just pick on Arizona. Back on 3/23, we had 59,000 people apply. 29,000 people apply, excuse me. On 3/28, we had 88,000 people apply. On 4/4, we had 132,000 people apply. Last week, we had 95,000 people apply, and we're sitting at 52,000 this week. There's no way they have the manpower to go through and verify everything. Basically, if you say it was Corona in today's environment, they just say, God bless you, here's your money. The same thing is happening with forbearance programs. If you call your bank and say you need help with the coronavirus, all they're asking for is to prove you're not employed or prove your income has taken a hit. They're not asking you to prove all your assets or anything else. I mean, some of the banks like Wells Fargo might, but Wells Fargo just got their head slapped recently, so we won't count them. The other banks are just given the forbearance program. I've seen some where I worked with some people, we called their bank and said the person can't make their payments. They said, how can you make the payment? How much can you pay? When can you pay it? How do you want to handle the rest? And that was the argument to get in the forbearance program. You. Not what they need, you. So these people getting into the forbearance program don't have a high requirement to get in, but it is causing a problem. And the problem it causes, which Wells Fargo displayed really well. If you remember, Wells Fargo said they wanted to open up and do SBA loans. Because of their reserve requirement, because they weren't doing business real well 5 years ago, the government increased their reserve requirement as a penalty on them, so they could only do 10 billion. And they were whining and crying that it wasn't fair. They could only do 10 billion if they had a reserve requirement like most of the other banks, AKA Bank of America and Chase. They could have done 390 billion, which would have been the entire amount that was available from the SBA. The government relieved them and allowed them to do 100 billion. Well, we have the same problem with residential loans. There's a reserve requirement the bank must have when they loan you money. And that reserve requirement is based on two things. Your deposits in the bank, or whoever has bank accounts there, their deposits, and performing assets. A performing asset is an asset that has a loan on it and the loan is being paid. So when this 2,000% increase in forbearance requests comes in, those forbearance properties are no longer a performing asset because they're not paying their mortgage anymore. Even if they're paying a part of their mortgage, they're still not a performing asset. As part of the Dodd-Frank Act, the reserve requirements and the performing asset definitions changed. And we didn't see this in years past, we see it now. And the change has caused some unnerving within the market. Because what happens is they can't switch money around from deposits to cover non-performing assets. The non-performing assets have to have cash added from the bank's money, not the insured money. And your savings accounts and your checking accounts are generally insured. So what ends up happening is as these assets aren't paying their mortgage, the banks face a cash crunch. They're not getting the money in. The amount of loans they can make get lowered. The amount of reserve they have gets lowered. They got to add more money to the reserve. Suddenly they have a cash problem. So the banks get nervous. I think Chase did this really well. Chase announced they were shutting some of their branches for the coronavirus, and they were furloughing. They didn't say furloughing. They said they were redistributing their employees to the branches that were open, but they were working less hours, and they were shutting the lobbies in many of their branches to keep the coronavirus from spreading. And the media ate that up. Pretty soon, Wells Fargo and Bank of America announced they were doing the same thing. The interesting part is the coronavirus and the fear of spreading it in the lobby is not why the bank shut their lobby. If it was, they would have no lobbies open at all. They have lobbies open. What they were doing is they were reorganizing their banks so they had less payroll. They weren't getting as much money in, so they couldn't make as big of a payroll. They were reorganizing their payroll and reorganizing their rents and their expenses to counter the cash crunch. They did a really slick job of it, and nobody got that point except a handful of people. Most people believe the news media story for it. There's a cash crunch. They had to solve the cash crunch. That's the way they chose to do it. Now the question for Chase is, how long does this deference program go on? How long does COVID-19 go on before that no longer works and you have to legitimately start slimming down your staff and slimming down your expenses, just like you or I would have to do if we didn't have enough money coming into the bank. And that's kind of the problems the lenders are facing. So what does that lead the lender to do? It makes the lender nervous. As a matter of fact, I was talking to a lender back on the 28th of March, and he summed it up this way. Lenders were freaking afraid. They were so afraid of what was going on that they weren't happy loaning money. A bank makes its money loaning money, and suddenly they're afraid to loan money. Now you have to remember, we have to go back to the Dodd-Frank, the Wall Street Reform Act. We used to talk about it a lot. We don't talk about it much, but part of that act, or the heart of that act, was protecting against primary mortgage defaults by lenders. And instead of saying the lender was responsible for not making their mortgage payment, the Dodd-Frank Act said if somebody could prove that the lender didn't do everything in their power to make sure the individual could pay their mortgage, the lender was responsible for the default. And that meant the lender had to return the money that the mortgagee paid. And we don't know what that return the money means. Is that the down payment? Is that all the payments they made on the house when the lender forecloses? We don't know because it's never been challenged, because we've never seen a time where we had that problem until now. But if you're the lender, you're afraid. Stocks are tanking, you're afraid. Bonds are tanking, you're afraid. People aren't paying their mortgage, so you're not controlling your reserve. You're afraid. And when you're afraid, you don't want to loan money. Back when Dodd-Frank first came out in 2010, we were fighting this stuff. Banks had draconian lending policies because they were afraid. Well, guess what? Banks are doing it again. I've seen banks turn down people because not they were laid off recently, but because the company announced layoffs and the person might be in it, the bank would not approve their loan until the person could prove they were not being laid off. At the same time, we have some new lending rules out there that are positive to us as investors that say to verify income, it used to be you had to have a note from your employer, or after 2010, they had to directly talk to your employer and get a verbal verification. The reason to talk to your employer was nobody could forge a note that way. Well, now with everything going on with COVID-19, suddenly they say you can provide a pay stub, you can provide last year's tax return, you can provide a letter. They no longer have to talk to anybody, which makes your pay much more questionable to a lender. That's a positive to us, but while the lenders are in fear, it's a negative to the system. So lenders are in fear. They've started changing the rules. There's one lender out there that no longer requires a 640 for FHA. They require a 720 for FHA. FHA has tightened up some of their rules. So lending became a little tougher. That's the bad news. The good news is, as interest rates have stabilized in the last 2 weeks, the lenders are becoming a little more, shall we say, liberal with their lending, or a little less conservative or less draconian. They're becoming more comfortable with the market. They're becoming more comfortable with their ability to verify. And all that got a big hit this week, a big positive hit this week, when President Trump said he wants to reopen the economy. The stock market took that as a positive sign. The lenders took that as a positive sign. That helps all of us. So we've taken care of the lenders and their problem. Everybody wants to know, will the interest rates go up or down? The interest rates are going to bounce a little bit. Right now, probably not much, but you want to watch to see what the interest rates are going to do. Watch the 10-year Treasury yield. It's published every day in the paper. You can find it online, anywhere you want to look. You don't need to watch it all day. Just watch where it's closing every day. For those of us in the West, it closes at 2 o'clock our time. For those of you in the East, that's 5 o'clock your time. Look at what it closed at. It'll tell you what the interest rates are going to do. Now, just because the Treasury rate went up today doesn't mean interest rates are going to go down tomorrow, because you still have the supply and demand function on interest rates. The more people that are applying for loans at a set interest rate, the less emphasis there is for the lenders to reduce it. So you still have supply and demand on interest rates too, but it's still Treasury bond based. So if the Treasury bond goes up for 4 or 5 days running, then we expect to see interest rates go down a little bit. If the Treasury note goes down for 4 or 5 days, we might see interest rates inch up a little bit. But remember, if it goes up or down 2 or 3 points, you're only looking at an eighth to a quarter of a point drop. So you're not looking at something major. The Treasury bond would have to go up somewhere around 8 to 10 points to really see any significant drop. But watch it. That's the answer to whether interest rates are going to go up or down. So if we take care of the interest rates and they're finally starting to get better, and there's still money available, because some of the people that are going in for the deferrals and the forbearance are finding out it's not what they thought. They're deciding not to follow through with it. So there's still money available. So now we got the problem of demand. Demand is governed by people that want to buy houses. Is there demand for housing? Yes. As a matter of fact, the National Association of Realtors did a survey. In the survey, they asked real estate agents how many of their buyers were delaying buying a home until after the bat virus was over. Now, I like the bat virus. It makes us all batty. After the bat virus was over. And the answer given by the National Association of Realtors was 6 out of 10, or 60% of the agents that responded to the survey were seeing their buyers delay 2 months or more for buying a house until the COVID virus or the bat virus was over. Interestingly enough, they asked the same question of selling agents that were dealing with sellers, and asked what their rate was, and they were saying 57% of their sellers were delaying selling until they could get out of the house, and they were more comfortable with people looking at the house. So just with that little survey, we see there's a 3% higher demand than there is a supply, just in the resale market. Now, normally some of that would get taken up with the builders market, but as I said, the builders aren't keeping up right now, so that it gets worse. We had a 15% difference between supply and demand going into this. And to be perfectly blunt, not enough people have died to really impact that supply and demand. Have some people's priorities changed? Maybe. But it's safe to assume that the majority of those people that wanted to buy a new house and the majority of those people that wanted to move still do. And they still intend to do that once this market clears up. So we still have a supply and demand problem that's been irritated by the builders not building. Even if the builders get started, soon as this ends, say this ends Memorial Day weekend, which I don't think it'll survive beyond that. Say it ends Memorial Day weekend, and the builders start on day one building more houses. You're still looking at 6 months before they can help you. And if they got to pull permits, you're looking at probably a year. So they can't help. So we still have a supply and demand problem. So now the only question is, does the demand have the money to buy a house? And when we go back to the unemployment numbers, it's interesting that the unemployment numbers are rising, but so has the income. For the same time the unemployment numbers are rising, we see that hourly workers in the last month are making 3.1% more than they were a month ago for February. This is March. We're seeing salaried workers are making 2.7% more. So unemployment is rising, but we're also seeing the income rise. As a matter of fact, Case-Shiller did a snapshot last week for the week ending April 6th or April 8th. And in the snapshot, they showed hourly income rising at a consistent 3.6%, and salary income rising at 3%. So let's just round both of them off and do cowboy math. Both hourly and salary people income is increasing at 3% a quarter, basically. And that's kind of misleading, but just to keep that thought in mind. But we got unemployment. How can we have so much unemployment, but we have income increasing? It's an interesting conundrum. But to us as real estate investors, we don't really care. What we care about is incomes are increasing. Incomes have been increasing for the last 2 years. And I've been telling my real estate agents to watch the income increase, because in most areas, housing is following that, just below it. As a matter of fact, the national income increase in the fourth quarter of last year was 3.1% average across all jobs. And the average housing increase in the third quarter of last year for the nation was 2.7%. It's staying just below it. If income is increasing, the housing market continues to follow the income. Well, wait. What about the unemployment? You got to remember that a lot of these service people that are becoming unemployed are not the people buying houses. Some are, but a lot of them are the people renting. And it's unfairly impacting the millennials and the Generation Zs more than most of the other generations. Although it is hitting the older baby boomers that are working part-time too, it's impacting as a group the millennials and the Zs more. They're also the renters more. The millennials are just starting to buy houses. And that's important to us because they're some of our buyers. But it says that it's not hitting the home selling and buying market that much. So if the buyers have a relatively stable income and we have jobs out there, then we're okay, with one caveat. How long will coronavirus bother us? We know now that likely we're going to start coming out of this somewhere in the month of May. We're going to start seeing businesses open. But if you really drive around your areas and you're not in the militant states where they're using the National Guard and the police to keep people from wakeboarding on an empty beach in LA, or Michigan where they're arresting people for protesting because they're not supposed to be on the street, and then they have to go back and say, oops, we made a mistake, we can't arrest protesters, that's a right. If we forget those states for a minute, our business is opening up regardless of what the government says. In some cases, it's the government actually trying to arrest people because they're opening businesses and then having to back off because we've got civil liberties problems with that. You know, I don't know how your state is, but for northern states and for Arizona and for a large part of the West, come Memorial Day, people are used to going someplace. Good Lord, Michigan said it wasn't fair that people went to their vacation homes when some people couldn't, so they outlawed it. But come Memorial Day, people are going to go. And I'm just going to pick on Flagstaff here. Flagstaff, Arizona said they don't want people from the valley coming up there. They said people from the valley would bring coronavirus with them. They wanted them to stay away. And when it was noted that people were going to come up to the mountain as soon as it started getting hot, the mayor of Flagstaff said he's going to put his police department along the exits of the highway and keep people from coming into town. There's 5 million people in the valley. 3 million of them head for the hills when it gets hot. I don't care how big your police department is, it's not going to stop 3 million people. All you're going to get is crushed police cars and crushed people as the traffic plows over them. It's just unrealistic. It's a good soundbite on TV, but it's unrealistic. So now you're the governor of New York, Governor Cuomo, or you're the governor of California, the two most outspoken against Trump opening up the states, although Michigan is joining them. What's your plan to stop the crush of people that want to get out of their house? You really can't unless you're going to put military in the street, and that's not going to fare well anywhere. So part of the problem is, even though they're saying they're not going to support the opening of the economy, unless the numbers change drastically on COVID, the economy is going to open up before Memorial Day because the people are going to open it whether the government wants to or not. I mean, people are going to decide that they can get out, and they're going to go to their favorite restaurant and they're going to say, we want to eat, and the restaurant needs money. They're going to open and let them eat. You can already do that. I went to a restaurant the other day to get some takeout, and they were letting a handful of people come in. They just put out a news report in Phoenix that even though the governor said restaurants were supposed to be closed, the restaurants were still letting policemen in to eat. Duh. It's what it is. The people are going to start doing business. So we know now that COVID-19 probably will not survive through the end of May as far as a shutdown. We know that businesses are going to reopen. As businesses reopen, we know people are going to get their jobs back. The question isn't, will the economy start improving? The question is, how long will it take to improve? The question normally asked is, will it be a V or will it be a U? It's hard to say. The only thing we got to count on or to look at is what happened to China after their shutdown, because no place else has opened up yet. China was a V. Their stock market quickly climbed. Their housing market went up 3,000 points in the last 2 weeks. They quickly climbed because the demand that was there before the shutdown was still there after the shutdown. And once people got comfortable, they started going out and looking again. And people are getting comfortable. It's kind of like 9/11. Remember how much in fear we were? Well, some of you that are young don't remember. But for those of us that aren't so young, remember how much fear we had after 9/11. And after a while, we just became comfortable with it and what was going on, and we just got back to our lives. That's America. So all this hype about the market being down doesn't really help anything because we still have a demand for housing. We still don't have enough housing. Now, how do I know that's true? In theory, housing prices should have come down, right? In theory, we would have thought that because we've seen a reduction in listings and we've seen the houses that were in a temporary state extend. As a matter of fact, in the last month, we've seen listings drop 27% from this time last year. Not 27% across listings, but 27% from what we would have expected based on last year. We've also seen about a 16% increase in days on market as it's taken longer to close houses. Everybody working from home is nice, but it has its own issues and things slow down because of it. We've seen the numbers of listings on the market increase, but part of that is because of the 16% extra days on market on the pendings, but we've also seen the active listings increase slightly. But we haven't seen them increase enough to do anything. We started off this with a 1.7 month supply of housing in the national economy. We've still got a 1.8% supply of housing in the national economy. Some of your areas that got snowstorms late got a little extra hit to the housing. Most of us that didn't get snowstorms still have the same amount of housing we had when we started. So we're not seeing a big increase in housing. As a matter of fact, we're seeing some areas like Phoenix, for example, that we've only seen a 1% drop in housing. But the interesting part is, what about the prices? Prices should be dropping. We've seen the prices drop in new homes. Interestingly enough, we've seen the wholesalers drop their prices. But housing on the open market, the traditional housing for buyers and sellers, not investors, has continued to increase. The first quarter of this year, the national average increase was 1.2%. An increase in places like California and Florida and Phoenix was much higher. As a matter of fact, Phoenix was at 7%, and it was not even the top in the nation. The top in the nation was Idaho at almost 12%. And there were several parts of the country that were above 7%, including in the Northeast. California, you were 6%. Arizona beat you this time. But anyway, we've seen the prices increase. Prices only increase when the supply is less than the demand. When the demand is less than the supply, prices fall. So we know we still have a supply and demand problem. So what have I said about the housing market? The housing market is still healthy. The housing market still has its demand. What do we think will happen when the economy opens up and people aren't worried so much about stuff anymore? We think the buyers and sellers are going to come out of the woodwork and want to buy and sell. Now, we're all investors. Tomorrow, I'll talk about how we can take advantage of both where we're at now for the next month and where we're going to be in the near future, so that we can get a little bit of the uptick ride too, because there is opportunities out there. I mean, some of these wholesalers are in trouble with their money, so they're trying to get rid of property. Some of them aren't bad deals. Builders are in trouble with their money. They're trying to get rid of property. I don't know if you all know this or not, but when the lending got tough and when the economy started tanking and when the stock markets dropped, good Lord, the stock market dropped 35%, 36% in some areas. When the stock market dropped, the commercial lines dried up. Building dried up. The ability of the lenders to give builders money dried up. The ability of the builders to draw down their credit dried up. So they were trying to finish building out their phase of their building so they could get that money back so they could get more money to build the next phase. This only happens when commercial lending dries up, and commercial lending dried up. The builders couldn't pull on their credit. You know, it's kind of like the old, one of the worst pieces of advice I saw for investors, take a tangent for a minute, just happened to be today, and it comes from a well-known investor site that puts out a lot of emails, but I won't name them. And they said that one of the 6 things investors should be doing right now is getting more credit cards and taking out HELOCs in case this economy continues the way it is for a longer period of time. That is exactly 100% wrong and stupid. First off, if you take out a HELOC and you draw that line of credit and the bank decides that the economy is getting bad and they need their money back, they call that HELOC. It is not under the defeasance or the forbearance control. It is a personal revolving line. They can call that and they can foreclose on your house without a problem. That is wrong. Getting more credit, that's great, but we've seen in years past where when times get tough, banks kill the amount of credit that you have. So you get a new card, it hurts your credit score overall, and suddenly the bank takes away the money on it so that you only have $500 available. Doesn't help you any. That is the wrong advice. Don't get confused. Builders have that same problem. I made it personal so you can see the builder's problem, but he has the same problem. If the builder had a $20 million line of credit to build his houses and he had $5 million of it drawn out to build the phase he was building, his line of credit is now $5 million. They killed the available credit and just pay back on what you have. So to get the next $5 million, he's got to pay back what he's got. So builders need to sell their homes. And there's some deals to be had with new builders because they can't sell their homes, partially because people don't want to go look. People are afraid that the home might have the virus in it. I mean, people are afraid the house might have the virus in it, the money might have the virus in it, the car might have the virus in it. People are afraid trees might have the virus. As long as people are afraid, you can make money in a bad economy. And that's what we're in right now. there are some winners to all this. I mean, millennials are hoping the housing market tanks. The media is hoping the housing market tanks. They spend a lot of time talking about it. As a matter of fact, in the last 2 weeks since the start of April, since April Fool's Day, the media has spent somewhere around 1.2 million minutes talking about how the housing market was going to go down. They have had real estate experts on their different channels talking about how the housing market is going to go down. The interesting thing is every time they have a true real estate expert on that knows what they're talking about, they talk about how they think the housing market is stable and going to go up. And the media quickly cuts away from those and goes back to the people that say what they want them to say. Millennials and the media are hoping the housing market tanks. The numbers aren't showing that. Unfortunately, or fortunately, depending on which side of the equation you're on, the numbers are showing that the housing market is stable and operating completely 100% independent of the stock market. That's a win for the housing market. That's a win for all of us. Now, normally when you want to make money, the best time to make money, as a certain investor said once upon a time, is when there's blood in the street and when people are running for shelter. We're in one of those times. It won't be as long as the last one, and there won't be as big of an opportunity as the last one, but it's not how long and how big it is, it's whether you're ready to take advantage of it. We're in one of those markets. There are opportunities abounding out there. I mean, good Lord, for the first time in Phoenix, you can get houses well below $200,000. We haven't seen that in over a year. When the market improves, those houses go back to being worth well over $200,000. I just saw a wholesaler advertise a property for $184,000 that legitimately in June, if this market improves, should be worth about $250, $260, and it doesn't need much work. But then on the other hand, I've seen a wholesaler advertise a property for $184 that when the market improves will barely be worth $200 because it's not a desirable house in any part of the town. So you need to be careful what you look at, but there's opportunity out there. Real estate has been a big winner. If you want to be in commercial real estate, buying warehouses, being a warehouse owner or being an owner of a medical services building or a medical service building complex have been big winners. Even though medical service buildings aren't getting their rent all the time right now, the demand for that space and the use of that space has created an opportunity to increase your rents for many years to come. Believe it or not, warehousing is getting their rent. Warehousing is getting premium rent. Clearly, there's been some losers. And when you start looking at winners and losers, you notice the long-term strategies are almost always winners. So if you're a landlord and you're not getting your rent right now, does that create a problem? Sure. I put out a video talking about that a little bit. Most landlords nationwide saw 97% of their tenants pay in April. Most of the landlords that didn't get their rent were in multifamilies. But even if you don't get all your rent, does that mean you can't negotiate to get the majority of your rent to cover your mortgage and defer the others like the bank is doing until a later time when they can pay it? You have options. Being a landlord, your property is still appreciated. If you're in Arizona, well, you're in Georgia, your property is appreciated 5% in the first quarter of this year. So if you spend $100,000 on your property in December and you still own it, it's worth $105,000 today. You made $5,000 just by keeping the property, not counting anything you made on rent, just pure appreciation. It hasn't gone down. So the long-term rental strategy still works. Fixing and flipping, if you were trying to sell your house right now and you had to get your money, you're probably going to get less than you could have trying to sell right now, but you're still making money. Same with wholesaling. You may get a little less than you could have back in February, or you might be able to in June, but you're still making money. But wholesaling has become tougher because the problem with wholesaling is when you wholesale, your buyer has to come in with money. Your buyer's 401ks are down. The stock market took a 35% hit. So if they had if they had $100 in there, just to put this in perspective, they have $65 now. So they've got a third less money, and they've got rules on how much they can take, so they don't have as much money to buy houses anymore. Well, then they can just go get a hard money loan. Hard money dried up. Hard money is commercial lines of credit. They dried up. So wholesaling is a short-term strategy. That short-term strategy has taken a hit in the short term. So if you were wholesaling, you better be able to hold the property, or you better have enough margin in it you can reduce your price, because your buyers have taken a 30 to 35% hit, or a third of their income hit. They're going to look to get that back somehow. That's the problem the commercial wholesalers are having. You know, the guys that send emails. Wholesaling in Arizona in the last 3 weeks, there's been exactly one house go to auction. One house. Normally we have many more than that a week. There's been one. There's been more than that slated, but there's been one. So one of the sources of buying houses has gone away. The most noticeable hit was probably not in either one of those, but in vacation rentals. The hospitality industry, interestingly enough, the number one loser in this entire COVID-19 scare is hotels and motels. Number 3 is multifamily. But when they say the hospitality industry, this is what makes time or vacation rentals, time rentals, this is what makes them really hurt. They don't consider you hospitality. They consider you temporary housing. So when they're talking in the new stimulus bill that Congress kind of killed, and now they say they're not coming back till after the end of the month, this month, since we can't pass a stimulus bill, it's not likely to happen in the short term, but when they talk about the stimulus bill, they keep talking about money to help the hospitality industry. They're not talking about you guys doing vacation rentals. They're talking about hotel motels, people that rent in multi-units more than a single night a week. Yes, I know some of your vacation rentals rent 2 or 3 nights a week, but not consistently. Hotels do. You're considered time rental. They're not talking about time rental. So not only do you not have people coming to rent your units, but the government money to help with the losses of income don't help you because you're not considered in the same breath as the hospitality. That's a short-term strategy that has taken an incredible beating. I mean, there's other ones we can pick on. Short sales. Right now, short sales have taken an incredible beating. Why would bank want to do a short sale? So just do a forbearance and the government gives them credit for doing it. On the other side of things, Subject 2 got a boost out of this. There's properties that actually have value, and there's people that actually want to leave those properties and they're willing to let you go and take over their mortgage. Subject 2's seen a great boost. You got to find the right seller, but it's still seen a great boost. Could you parlay Subject 2 into a builder's properties? Possibly. It depends on what his bridge loan is. If his bridge loan, or if he has his own lending company that takes the bridge loan and pays it off and then refinances it under his lending company, that would all be Subject 2. It's possible to do that. There are opportunities, but some things have taken a hit. The number 2 hit is senior family housing. And I find that hit worth watching. People are worried about the amount of age people that died in these houses. So they're trying to figure out how to move them into their homes. Now, having had my grandmother live with us for several years, I'm not sure how well they're going to like that. But it takes a bigger house. It takes more space. It takes more. I mean, when my grandmother lived with us, we needed hallways that were wider than 36 inches for her scooter. We needed doorways that were wider than 36 inches for her scooter. When you start doing that stuff, those people that are moving their family in with them need to find a house that serves their need and the new senior person's need. Things like walk-in showers. So it creates a potential for even more demand than we started with within our marketplace, but less demand in the senior housing. So as investors, it's an opportunity that's sitting there hanging there that we might want to pay attention to. We were supposed to be done 8 minutes ago. I never actually get done too soon. I just want to say one other loser, two other losers. Congress has definitely lost. Their approval rating has gone down incredibly during this process. The other loser has been the American citizens. As investors, we need to be taking advantage of this time. I'm going to talk to you about that tomorrow. But let's face it, if you're not buying property, you ought to be getting ready to do it in the future. So a couple of things that have recently come up that are in our advantage that we might want to take a look at. Facebook, YouTube, and most of the other social sites have lowered their advertising rates to make it easier and cheaper to advertise to the public. That's a good thing. There's some ads out there that you can get for pennies on the dollar. Interestingly enough, people are home. We all know that. People are tired of watching TV. AT&T reports a 27% increase in data traffic. Verizon reports a 33% increase in data traffic. But what I find interesting is AT&T is reporting a 36% increase in voice traffic and Verizon a 29% increase in voice traffic. So not only are people going online more, but they're bored and they're calling people just to talk. If you're an investor, you ought to be trying to talk to all those people that you know, all those people that might have been selling, all those people in neighborhoods that could be selling, because they're looking to sell. I don't mean to blind call them because people don't like that, but if you have a relationship with them, why aren't you reaching out? One last thought I want to leave with, it's 5:10. We all saw that back when this all first started, back in the week of March 13th, we saw Opendoor and Zillow and Redfin, which is really Zillow anyway, and several of the other e-buyer companies suddenly cancel their contracts and pull out of the market. And the amount of goodwill that they lost for doing that is probably not easily recoverable, but it creates an opportunity for all of us because there's less people out there competing to buy property suddenly. Add in one more thing, we saw last week that Redfin laid off 41% of their agents. Actually, Redfin says that they furloughed them, which is an old factory term for saying laid off. But the interesting part is you talk to Redfin agents and they were told to leave the office. They were no longer needed. That sounds more than a layoff or more than a furlough. That sounds like get lost, you're done. Just today, we found out Opendoor laid off 35% of their agents. So two of the biggest e-buyers out there have laid off their agents. I would expect we'll see Zillow follow suit in the next week or so. As they've laid off their agents, that gets rid of the goodwill within the real estate community, the professional side of the real estate community, which makes it harder for them to bring those people back. They will have a tougher time coming out and competing in the markets. That's good for all of us. The more investors or the more competition goes away, the easier it is for us to do our jobs. So that's good news for all of us. We should be counting on that. One other thing you might want to be aware of, I don't know if Mark's told you or not, but the IRS extended the deadlines for 1031 exchanges. The 45 and 180 days, if they occur between now and the 15th of July, the date is the 15th of July. If the date would occur after the 15th of July but starts before, it's the new date, whatever's longer. So the earliest would be the 15th of July for your 1031s. The longest would be 179 days after the 15th of July, fundamentally, if it's a 180-day clock. So that's good. So the market has good opportunity. The market is not collapsing. Our real estate market is strong, and it appears to be getting stronger even during shutdown. That's good. The question for all of you is, how are you going to take advantage of it? What are you going to do to take advantage of the market in the near term? And everything needs to be done quickly in the near term, because we're physically looking at this ending somewhere around the end of May, which is good for the U.S. economy, good for the real estate market, and good for all of us investors. Now, maybe you went on unemployment. I don't blame you. I mean, the government was going to give you $600 more. For a lot of people, the unemployment number with the extra $600 was more than they were making in their job. So I don't blame you for doing that. But all that does is give you money to figure out what you're going to do moving forward. If you're not actively planning moving forward right now, you're making a mistake. And you're making a mistake that will be hard to recover from. You've given this opportunity to take a deep breath and figure out what you want to be when you grow up. Take advantage of it.